Telstra has delivered a full-year profit of $4 billion. The telco giant held its dividend steady, but elsewhere in the company, big changes are afoot. To guide us through the full-year earnings as well as other developments within the company, we have Morningstar Head of Equity Research, Peter Warrens. Peter, nice to see you again.
You too, Vicky.
Peter, first of all, what did you make of the profit result?
There's no doubt it was a better than an expected result. It had a 4 in front of it. That surprised everybody. The consensus was around about 3.8 billion. Came in nicely above 4 billion. Morningstar, thankfully, were the highest in the market at 3.97, so that was good. And everywhere in the result, it wasn't too bad. There was no weak spots there. Some of the critical areas like revenue were just a little off the pace. The EBITDA line was within the guidance range, but at the low end.
Peter, were there any surprises in the guidance?
Vicky, there were, and that's one of the reasons why the market reaction to the better than expected result was negative. Now, guidance is what management want to feed into the marketplace for either revenue or earnings or margin for the next year or for a certain horizon. So, Soltageo previously had indicated that for FY10, the EBITDA margin, the earnings before interest, tax, depreciation and amortisation, that margin to sales revenue was targeted between 46 and 48%. What David Thodey said yesterday, he said, well, hang on a second, we're in a bit of a recession here, let's just be a little bit more conservative. And he has maintained the FY9 EBITDA margin at 43.2 and said that'll be fine going ahead for FY10. I suspect it's a tad conservative, but that's the line in the sand he's drawn, and the market was not comfortable with that. So the analysts had to go in there and rejig their numbers. To give you an idea, we had to take $700 million off our EBITDA estimate, from about 12 billion back to 11.3 billion, and then all that filters back down. So we had to downgrade our earnings for FY10 by about 10%. The fair value didn't change much, but that was a surprise, and that's why the market was a little negative on the overall package, if you like, from yesterday.
Peter, over the long term, there are some changes afoot within Telstra. We keep hearing about a functional breakup, and there's also the company's probable involvement in the national broadband network. Do shareholders need to worry about these things now?
The market certainly is, so I guess shareholders should be as well. And there's no doubt that something's got to give. I mean, there's too much pressure, external pressure, from regulatory bodies, their competitors, and the government to, separate this thing, divide and conquer, so to speak. Because they are, it's a very, very powerful organisation delivering exceptional and world-leading technology and communications, but it's going to be separated. Now, whether it be a functional separation, which is kind of the easy end of the separation, or an operational separation, which means you will separate the network, the infrastructure from the retail operation, which would be, if you like, the British Telecom model, that would be the worst-case scenario. CFO Stanhope said yesterday that that would probably take a 5-year period and could cost Telstra up to 10 cents a share in earnings. Now, 10 cents a share, they only earned 32 cents a share in the year just ended, so it is a significant impact. What we've got to understand is that with all the negotiations that are going on, there has to be some big compensation payments made to Telstra if, in fact, NBN wants to get up in the 8-year framework. And quite frankly, I think that that's very, very doubtful. Unless they fully embrace Telstra, that time frame is not going to work. And so the shareholders have to get some benefit from this whole process. David Thodey is saying he is going to negotiate for the shareholders, from the shareholders' point of view, and that's his job, to make sure that he extracts the absolute maximum amount for shareholders, given that we don't want to really go into a real difficult negotiation. So there could be compensation payments well in excess of $10 billion, which is about $1 a share. Now, what will Telstra do with that money is the $64 question. Would they pay it back to shareholders? Would they pay half of it back? I suspect somewhere in between. And so it's this whole question of where we're going with NBN. There's many strings to this bow, and it's going to take some neat footwork to get through it.
Peter, thank you.
Pleasure.